You pay for life insurance every month, and you kind of just hope you'll never actually have to use it. It can feel like just another bill, right? A safety net that's also just a sunk cost. But what if it didn't have to be that way? What if that protection could actually be an asset? Think about it for a second. That monthly premium, does it feel like you're just renting? You pay for the privilege of being protected for a month, but as soon as that month is over, poof, the money's gone. That's how it usually works, but believe it or not, it's not the only way. And today, we're going to dig into the alternative. So first, let's just break down the model we're all familiar with, the idea of renting your protection. This is pretty much the foundation for the most common kind of life insurance out there. And renting is the perfect word for traditional term life insurance. It's super straightforward. You pay a premium for a set period of time, let's say 20 or 30 years. If you happen to pass away during that term, your family gets a death benefit. It's simple, it's pure protection. But here's the part that feels exactly like paying rent. The absolute best case scenario is that you stay healthy and you outlive the policy. Now, that's fantastic for you, of course, but financially, all those payments you made over the years, they're just gone. The contract is over, the protection disappears, and you walk away with nothing to show for it. Okay, so if that's the renting model, what in the world is the alternative? Let's dive into what we're calling the ownership option. Just imagine this for a second. What if you could get that same critical death benefit, that same peace of mind for your family, but with a total game-changing twist? If you outlive the policy, you get your money back. Like, all of it. All of a sudden, it stops feeling like just an expense, doesn't it? And this slide really lays it out, side by side. On the left, you've got the renting model, which is basically a one-way street for your money. But on the right, the owning model, which is actually called return of premium term life, it creates a round trip. You get the protection, and if you make it to the end of the term, you get a return of your eligible premiums. So, how does this whole thing actually work? You might be sitting there thinking, okay, what's the catch? But honestly, the mechanics of a return of premium, or ROP policy, are surprisingly simple. Let's just walk right through it. The whole life cycle is pretty clear. You pick your term and how much coverage you want, you pay your premiums, and for that whole time you're protected. The really key moment happens when you outlive that term. That's what triggers the final step. You get a check for the base premiums you paid in. Now, any fees or costs for extra features usually aren't included, but the core payment you made comes right back to you. Okay, so we've established that you can get your money back, which is great. But the way you get it back, well, that's probably the most powerful part of this whole idea. So just to be precise, return of premium isn't its own separate product. It's a feature, sometimes called a rider, that you add onto a term life policy. And its job is right there in the name. It returns the premiums you paid if you outlive the policy. Simple as that. I mean, let that sink in for a minute. This is not a partial refund. It's not some kind of store credit. It is a 100% return of your base premiums. If you paid, say, $1,000 a year for 20 years, that's a $20,000 check coming your way. But believe it or not, it actually gets even better. And here it is. This is the real game changer. That big lump sum you get back is generally income tax free. The IRS doesn't treat it as income. Why? Well, because they just see it as you getting your own money back. So you get to keep every single dollar. So all of this brings us to the final question, really. You've got these two models on the table, and it all boils down to a choice that depends entirely on your own financial goals. This table lays it all out pretty clearly. The core protection, the death benefit, the term length, it's identical for both. The big difference happens at the very end. With traditional term, your money's gone. With ROP, it comes back. Now, the one thing this table doesn't show is the cost. ROP policies do have higher premiums, so you're paying more for this ownership feature, and that's the trade-off you have to consider. And so we end right where we started, renting versus owning. Do you prefer the lower cost of just pure, simple protection, or is paying a higher premium for that ownership outcome with a tax-free return at the end a better fit for your financial future? It's a really powerful choice to have.